industry analyst for S&P Equity Research. I'm here today to follow up on the housing webinar that we had earlier today. There was a large influx of questions, and we wanted to make sure that we could answer some of them for you. So with that, I'll get started. First question is, in spite of the recent home price recovery, what is the latest estimate on percent of homes underwater or with less than 20% equity? So this data is readily available from Zillow. They last came out with numbers in May. So obviously home prices improved a lot over the past 12 months. There's 2 million fewer homeowners out there that are underwater on their mortgages. There's still over 13 million, or about 25.4% of people with mortgages that are still underwater. The percent of people who are underwater or that have equity less than 20% in their homes is actually 43.7%. So certainly home prices are helping this out, and we expect the improvement to continue. But that said, there's still a significant amount of people that are underwater or still in distressed positions on their equity. Another thing that we received, what do you think normalized new home construction's seasonally adjusted annual rate is? If we get to these levels within the next 2 years, do you think home builders are overvalued? Great question. I think it's, based on population increases. Well, going back historically, the average SAR for housing starts is about 1.5, 1.6 million. There have been population increases, obviously, over the last several years. So you could probably say that the SAR could potentially be higher than that. Obviously, with an aging demographic and weak household formation, I think it's unlikely to reach those levels soon. We think a SAR of about 1.5 million is probably more likely for normalized levels over the next 10 years or so. And so the question about home builders being overvalued, if we get back up to that in 2 years, I think I think the home builders are kind of baking in assumptions of about 50% EPS growth. And if that does happen, I think we probably would be at a SAR about 1.5 million in 2 years if you kind of back in the fact that they can probably grow revenues at 30% or so. And then that would be, they would obviously have greater market share than the private builders. So maybe that would be an increase of about 25% in starts. So if you back it in that way, I think that's kind of what's baked in, is that the assumption that we're going to get back to those levels over the next 2 years. My view is a little bit more cautious than that. As I mentioned in the presentation, I think there are a lot of reasons why household formation is going to remain much weaker than has been historically, and I think it's unlikely that investor demand is going to be the sole reason why we kind of get up to those levels. So my view is that I think that's what's baked into their valuations, but I do think that's a little bit of aggressive forecast. And then the last question I'm going to take for you today is one on Blackstone and some piece that I mentioned earlier in my presentation. The question is, you mentioned that Blackstone purchased 16,000 homes last year. There were around 5 million homes sold last year. Institutional investors still make up a small share. How can investors have such an impact on the market if they only make up a small share? Now, I guess what you need to keep in mind here is that Blackstone makes up only a small amount of the total institutional investor base. There are several hundred institutional investors out there, so Blackstone is just one of those institutional investors. In addition, there's foreign buyers that are considered investors, and there's also people who have the cash and buy homes as an investment, not just as a place to live in, but for a vacation home or as a place to flip. So investment demand is certainly way more than what is accounted for just solely by Blackstone or the institutional investment side. As I mentioned also in the latest existing home sales numbers, 32% of those were all cash buys. So I think that's more representative of the amount of investor demand that's currently in the market. And given the fact that rates are rising, and even in their survey, it sounded like investors are a little bit more tepid on going forward on their projected rate of purchases. So I'd be a little bit more cautious on that driving the market going forward. I think you're going to need to have more sustainable demand led by first-time home buyers. And that wraps it up for my questions.